Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, November 16th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead Trader Viper XL 007, and we are going to jump on the mainstream media news to this little company you might have heard of. I don't know. It's really tiny. Crypto company FTX Exchange, led by SBF. They apparently got into a little bit of a liquidity crisis, and it made the news a little bit. But before we hop into that content, I want to give a shout out to our Discord, a link in the description below. You can hop in there, join for free. You can say hello to myself, Viper, several of the other Blockhead traders. Love to hear what you're trading. Love to hear from you. You can also find a link to thetagang.com/sprocket888, where you can see every one of my trades, the good, the bad, and the ugly. This episode is also released as a podcast, so pick it up wherever you get your podcasts. So Viper, let's go back to the world of crypto here, and this little company of FTX, and I can't get enough of all of the irony that has surfaced over the past week or so since this company has basically become completely illiquid and folded and collapsed in and of itself. It just so many little bits of whether it's an ad that was aired in the Super Bowl, whether it is, the Shark Tanks that people on Shark Tank that dumped tons of money in this, the celebrities that backed them. This just looks like hook, line, and sinker. Everybody was involved in this thing, and just so much irony there. And I personally didn't have any direct involvement, direct exposure to this. I kind of sat back, and we might touch on it a little bit later. It has so many similarities to kind of my first foray into crypto and how it ended. I hope this is not foreshadowing how my second foray into crypto are going to end. But help me out here, help our viewers out. What is FTX and what the heck happened, and why does my grandmother know about this?
Yeah, it's been a week for sure, and so FTX, like you said, I feel like most people know the name. Even if you've never touched crypto, even if you just watch, literally, if you just watch baseball, they were a prime sponsor of the MLB, and every umpire's uniform had a little FTX logo on it. Super Bowl ads, like you said, celebrity backing, Tom Brady, Steph Curry, and some other ones as well. And then, of course, famously, Kevin O'Leary from Shark Tank was just, literally, there's a clip. There's all kinds of clips. Just search FTX funny clip or irony clip. Just like a month ago, of Kevin O'Leary, in an interview on stage saying, "Yeah, the safest thing I can do right now is put my money in FTX. The safest play I can make," and that didn't happen. But what I wanted to touch on, though, was a little bit more of an explanation of what happened, and some of it's just recapping a lot of things people have heard. And to me, there's something that I really want to focus on here because there's a lot of, we've talked about this through this whole bear market of the way news can get harped on or, used in certain ways or just misrepresented. And so what I wanted to do is we have this massive catastrophic failure. And it is very significant. Lots of people have lost lots and lots of money. So I do want to try to, keep that in mind. But also, really help distinguish what happened and what does it mean in the context of crypto or blockchain technology. Because I think that's two very different things and two different very points that are very important to draw. And in the layman's terms of interpreting the situation, it's getting conflated of this was bad, this exploded, therefore, and conflating these two things. So So that's at least I want to set it up front. The intent, who knows how we end up going here through this. But the intent is to try to educate, round out the perspectives that I have from being in this crypto world, and then also kind of touch on Sprocket, we'll call it PTSD that certainly has probably been triggering quite sufficiently. So I guess where to start. Well, let's jump into just in general where we stand, market wide, as far as like just looking at Bitcoin, what's happened on the Bitcoin chart in relation to all of this, and just contextualize that with where we are, because we do frequently say news is a binary event, and I've really been trying to stick hard to that through this past week. There's so much fear, uncertainty, and doubt. There's so much FUD around all of this, not just, in the non-crypto verse, but also in anybody in crypto, myself included. I mean, last Thursday, Friday, it was the same sort of thing of like, is this it? Is this, so I wanted to just real quickly take a quick look at the Bitcoin chart just to show the impact we're talking about, because we generally, Bitcoin generally indicates the market for now. So the news broke, and we had this leg down here, which equates to a move of about 23%. So significant, very significant. If we zoom out to where we're at this point in time, it's, it's kind of par for the course. We've had bigger legs. This big tumble down back here was the big Luna event of Luna collapsing. So that, in a way had a more significant price impact. We can do a quick check just because the visual might not. Yeah, it was 50% back there. So we're talking about this little leg here. And then, just reaffirming the news and being binary events and whatnot, looking at the big picture here, this isn't super unexpected as far as downtrend of the chart, not trying to call bottoms, but just, having the swing that, made these two highs back here, starting in down here around $10,000, $11,000. Anybody that has listened to anybody that has more of a crypto slant and crypto predictions, you've probably heard $10,000, $11,000 tossed around a bit. So contextually, that's what we're talking about is around here. But the sensational part of the story is when we really dig into what happened. And so this is just showing the moment things happened. FTX had its own token. So FTX was a centralized exchange, which we've talked about before in our various crypto videos. You have centralized exchanges, CEXs, and you have DEXs, DEXs, decentralized exchanges. And those are the two primary ways to move and buy and sell cryptocurrencies. So FTX was a centralized exchange, the second biggest in the world, Binance being the biggest. And it started some people suspect that somewhere around this tweet was when things really started to just the bank run, so to speak. So this is CZ Binance Twitter account. CZ is his name, but he is the CEO of Binance, the number one SEX or CEX centralized exchange. So he tweeted basically that Binance was exiting as part of their exit from FTX last year. They received roughly $2.1 billion US dollar equivalent in cash, which was in BUSD, which is a stable coin that Binance created, and FTT, which is the token that FTX had on their exchange. It was a token that they created, and that's going to come up a lot. So FTT is a token that FTX created to use as a reward token within their centralized exchange environment. Due to recent revelations that have come to light, we have decided to liquidate any remaining FTT on our books. So somewhere between $0 and $2.1 billion was being expected to be liquidated of FTT, which, as you can expect, triggered quite the panic, especially because this is not a very good look on FTX to have a massive player like Binance come in and say, we got to get out of here. We're liquidating. And I believe, so he goes on to say that they'll try to do this in a way that minimizes market impact. I don't know if it was on this thread, but somewhere along the way, he basically said that there was concerns around FTX being insolvent and not being able to support the assets that they held or the liabilities that they held. And so thus they were exiting. And then sure enough, we had, if we take a look at the FTT token, it just went off a cliff. As soon as he tweeted that, I mean, it's unknown what part of this was Binance, what part of it was the panic selling, but it doesn't really matter. I mean, you can see this was up at $24, runs down here $2, $1. And then there's also this Twitter account called Whale Alert, which just is like this algorithm that just seeks, watches transactions on all the different blockchains, and then it posts a tweet if it sees a massive move. And so Whale Alert popped out an alert saying that basically 23 million FTT tokens, which was a USD value of $584 million, was transferred from an unknown wallet to Binance. And so CZ confirmed that this was part of their maneuvering and getting out of the token and liquidating. So this kind of triggered the big what is going on, what is happening, and then subsequent bank run on the FTX platform, where basically you had tons of users. I don't know the exact user amount, but billions of dollars worth of user deposits in FTX as a centralized exchange, and everybody's now going and just trying to pull their money out, transfer it back to their bank, transfer it to some other wallet, just get it off the platform because nobody knows what's happening and this thing's crashing. And so, as goes the case with centralized exchanges, they have a button and they can just click it and freeze all withdrawals. And that was essentially what then went into effect with FTX. They froze all withdrawals, so nobody could withdraw any money. And they, started to post some public statements around, hey, we're looking into this, or we're trying to get, this, that, or the other, trying to do some damage control. But that's usually, at least so far in the evolution of crypto and centralized exchanges, when withdrawals are frozen, I have yet to see this resolve nicely and in a positive way for anybody whose funds are locked up on there. And that seems to be the case of what's gone on so far. Nobody's gotten access to those funds yet. Then things got a little bit worse. There were posts because, a lot of this, even though it's a centralized exchange, there is activity in and out of the exchange that happens on the blockchain. So you get all these eyes around the blockchain watching transactions of known wallet addresses. Then there started to be mass movement of large sums of money in the 10s and 20s and 30s. And I think it went up to $400 million that was moved off of FTX, which was claimed by FTX to be a hack. And I believe it's not fully confirmed, but there was a corroboration of a former employee. But there's also some suspicion around SBF, Sam Bankman, as to whether or not he had a backdoor through the software to be able to pull stuff out. But that's all the speculative front. Sticking to what happened. So the bank run happened. Everybody got locked out. And now we're kind of in this world of there's a lot of people's funds locked up in there. And now everybody's questioning, do these funds even exist? What happened? So as we've started to unravel, there's a few things that make this particularly interesting. One thing is, if we look back in time here, we can see, as we've talked on the show multiple times, as the bear market has gone on, we've seen collapses of centralized exchanges. BlockFi was one that went down earlier in the year. I believe we even mentioned on the show one about Voyager. And in both of these cases, you notice FTX whoops in here, and FTX to acquire bankrupt Voyager's assets. And they did. They closed that deal. FTX could buy BlockFi for only $15 million. And they did. They came in and struck a deal with BlockFi. So up until this moment, they were lauded by a lot of more mainstream financial minds as like the company that's out here trying to save all of these businesses. He was famously referred to as JP Morgan of crypto. And so what we're now finding out is there could have been another reason for this acquisition of these things to get access to these assets on these platforms. Because if we take a look here at FTX and Alameda Research, so there were basically two wings of the house. So FTX was the centralized exchange. Alameda Research was supposed to be this completely separate entity. It was a trading platform or a trading fund that people could put investment in, and it was a hedge fund, sort of thing that would trade clients' funds and whatnot. They were supposed to be two completely separate things. We're finding out that they were not really at all. The CEO of Alameda Research was very closely in a very close relationship with SBF as the CEO of FTX. And if we look here, this is a combination of things that FTX and Alameda had investment money in. And so this is a very broad spectrum of projects. You can see it's kind of broken down into different decentralized finance apps and NFT, gaming protocols and projects, all the way to entire blockchains. I mean, they were not responsible for any one particular blockchain, but they did significant investment in Solana and Aptos were two very significant blockchains that they had significant investment in. And so, you're kind of still looking at this like, how does this fall apart? And in a roundabout way, what is alleged, but there is a lot of data to suggest, as well as admissions from SBF himself, where he's basically said they got into an over leveraged situation where they were just over leveraging, funds that the company held, and it just kind of fell apart. And so, one way that I view this is if we take a very, very crude look here, this is the self-feeding Ponzi loop that was kind of going on here, where Alameda Research would take loans out from FTX, and FTX would fund Alameda Research with their own FTT token, which then increased the value of Alameda Research, which then enabled Alameda Research to go put these funds into all of these different investments down here. And this is also not fully concluded, but there are a lot of projects on this list that are claiming part of their contract with Alameda Research was that they were going to get this significant investment, $4 or $5 million, whatever. And one of the terms of the contract was the project treasury must be stored on the FTX platform. So all the money raised by the project has to be stored on the FTX platform. But as long as you do that, here's $5 million. And so now we have this complete loop here of we'll go invest in projects. They're going to go raise money, but then we're having them store that money on the FTX platform. And then, around and around we go, and we'll just keep this going. And, it's a money printer, right? Those just never stop printing. So in a roundabout way, that's kind of the gist of, and then obviously, I mean, I hope it's pretty clear how something like this can just completely fall apart, especially in a bear market, especially when valuations aren't doing good. But even forget that. It's just people want access to their money. They run on the bank, and the bank has no money.
Yeah, so Viper, one of the things that I kind of want to draw a parallel to because, a lot of times people think the centralized exchanges are effectively like your brokerage account in equities world. And for all intents and purposes, they're essentially that's what they're meant to be. They're the platform that you go deposit your money, make your transactions, move in and out of things. The key thing that I think is a big difference here is, this lack of regulation, lack of rules, lack of stuff around that, which is one of the ironies that I think is so funny because you brought in this, a lot of people, JP Morgan of crypto and all these like opinions. The thing that was also going on was SBF was going to Washington and touting, bring on the regulate this that's needed. And the irony here is in your regular brokerage, I use TD Ameritrade, Viper, I think you use TD Ameritrade, and there are rules against TD Ameritrade when they take our deposits to operate on exchanges. There's limited things that they can do with those deposits. They can't take those deposits and throw them in some research hedge fund thing on the side. There are rules and regulations in place that they have to have one for one equivalency of a stable, like US backed, so that you and I can pull out our money and there's not a run on that brokerage account. That was all missing and void in this FTX situation, which is one of the things that kind of exasperated it is, FTX was taking in all this money and rather than storing it one for one and facilitating the simple exchange function, they were leveraging out that money into Alameda Research and other places, which is kind of an illiquid or could freeze up liquidity to facilitate or to allow for that rapid withdrawals.
Yeah, absolutely. And that's, it's, there's a lot about this that is just, especially to people on the outside, that I think is a really good learning experience, without being wrapped up in it. And a lot of this goes along the lines of things we've talked about frequently on this show. And I personally, you've already said you've had zero exposure to this fallout. I have as well. I've had zero, and even looking like I went through, because there is going to be and is already starting to be a domino effect, a tragic domino effect of this, where this massive source of revenue, or I don't even want to say revenue, but just, buyouts and investments that they were putting into these other projects, like the projects that are putting their treasury into FTX, these are legitimate projects. Like BlockFi, for all we know, so far, like seems to have been a legitimate platform, or even away from anything finance wise, the games or the, people building that. This is all legitimate, effort to build something. They stored all their money into FTX and now they're locked up and they can't get their money out. So if they were a financial resource like BlockFi, now there are customers of BlockFi only who never touched FTX, but now they're locked out of their money. And so the dominoes are already starting to fall and will continue to fall. And I mean, I know at least one person personally that was very deeply invested in leaving money on BlockFi and just kind of using that as a bank source to pull out and move around on chain. And now he's locked out of a very significant amount of money, and probably not going to ever see that again because of this domino effect. So the important lesson thing here is exactly like you were just saying, as far as not treating until there's clear regulatory clarity is one phrase that gets thrown around a lot. Until there is regulatory clarity on exactly what can and can't be done and what happens when you step out of those bounds. This is exactly why you and I have talked about not wanting to touch any of these. I've mentioned on the show, I on-ramp through Coinbase and then I send it straight into my non-custodial wallet, because I have full control and ownership of that wallet. I'm not keeping these funds on a platform that can just shut me off. And so that's a really big thing about getting into this world. And, and I think if I were to try to sum up the biggest point I want to make about anybody even remotely considering getting into this space is just the education piece and knowing what everything is, not just saying, like, I mean, so many people would hear Kevin O'Leary or Tom Brady talk about FTX and be like, good enough for them, it's good enough for me, I'm in. Like, no, like, I mean, this is your money. Know where your money's going, and if you don't know where you're putting your money, learn about it. Doesn't mean it's a bad thing, but you need to learn about it, and through that learning process, that's how you and I have decided not to touch centralized exchanges, because we know the world and the risks, and that was beyond the risk threshold that we were comfortable with.
Yeah, I mean, at the end of the day, I kind of equate some of this. I'm always drawing parallels and analogies. So probably 10, 15 years ago, a lot of cloud services started emerging. Store your data here, store your data here. And then people were kind of shocked to realize that other people had access to things, the different security encryption. What do you mean that I made a direct message on Twitter and somebody else could read it? It was private. I'm like, no, it's not private. It's just a message that goes on through somebody's computer. And the same type of thing deals with these centralized exchanges where you are depositing, just like going to your bank. You're taking your funds and you are giving them, entrusting them to another entity, and you have lost control over that. And without the proper contracts, regulations, assurances in place, there's really, I mean, it's an extreme, crazy example, but there's nothing that says those people can't skip town with your money. And that's been one of the things that's been very important to me in crypto, is that I control the assets. I have access to them no matter what. Just like in information storage of things in the cloud, I'm very leery of what information I post to different cloud service providers. How is that information protected? Maybe I encrypt the information before I put it up there, because then even if it gets leaked, it's still protected by something I control. And so, it just goes to that: understand the technology and not just who the endorsement of that technology is.
Yeah. And so, I mean, that probably leaves us at a point where there's a ton of very valid questions of what is the point then? Like, if this could happen, if this thing is if this is an asset to be bought and sold, what the heck is even the point if you can't trust a platform to buy and sell it? And it's a very valid question, because it also strikes to the core of, I mean, I have my opinion, which I'll give some of it, but it also strikes to the core of just the newness of this entire space, which we'll call blockchain technology, which is what is underpinning all of these different cryptocurrencies and platforms and all that kind of stuff. And so a lot of it is just the newness of the space, and it trying to, us as a society, as people, trying to figure out how to use this. And when you're in the early stages before the regulation, there's a lot of malfeasance. There's a lot of just terrible scam, absolute blatant illegal activity, taking advantage of it. Hence the call for more regulatory clarity on this. But I would say, to the answer, or to the point of what is even the point, then, there's several points. One is, if you do learn about cryptocurrency, blockchain technology, all that sort of thing, and the only thing you get out of it is there's going to be these tokens, and you equate it to the stock market. It's like stock, and I just want to buy and sell this token. That's a legitimate path, but you should probably wait for that regulatory clarity. And I promise you can go Google. There's not that much. It doesn't take you long to find it. Fidelity, TD Ameritrade, Charles Schwab, they are lining up to offer these tokens and this cryptocurrency to expose their user base to it on their platform. And so all of a sudden, now you're using a heavily regulated exchange who will have the solvency to back those assets and all that kind of stuff. So, I mean, honestly, if all you want to do is trade this thing, like a stock or something like that, then waiting for that, waiting for organizations that fall into that that regulation camp is probably the best thing. But on the other side, there's also a much more complicated reason for the why, and that is much more on the side of ownership and full decentralization. And we've talked about DeFi and decentralized finance and all that sort of thing. And I don't want to get down that rabbit hole, other than to say there's a lot of perspective that I have that aligns with the value in that, not necessarily empirically from a finance perspective, but just from a usage perspective and all that kind of stuff. But what I will say to touch on the power of that truly decentralized finance. So you can have the DEXs, the DEXs, the decentralized exchanges. There's blockchain transaction proof that people found that Alameda and FTX, while they have tons and tons and millions of dollars of outstanding loans, they are completely clean on any loan they took out on a DEX platform. And they had a lot of them, and they closed them out, and they paid them back. And I mean, why would they do that? Well, because they're collateralized loans. We've talked about that on previous episodes. You have protocols like Aave, which is my personal favorite, but there's other ones where you have to put up collateral, which gets locked in code. It gets locked into a contract, a completely binding contract between you and a computer, that you will come back and repay your loan. Otherwise, this computer protocol will keep your collateral and it will be distributed to the people that fronted you that money. And now it's a trustless loan system. And so I thought that was at least a good example in this exact perspective of the fact that you can't cheat the computer code, and they're completely clean on those books because they had no choice. They wanted that collateral back. They repaid those loans. And it's when you're borrowing mechanics from traditional finance and applying them to this world of digital finance that you get all these other risks and things that we're more common with, of like people defaulting on loans.
Yeah, I mean, I specifically remember talking about smart contracts in one of our intro to crypto episodes long while back. And that was one of the benefits that we called out is in a traditional loan system, you rely on basically the ability to recover your money in the legal system, where you could quite literally get bupkis from it. And in those smart contracts, they're fully collateralized, meaning the value to pay them back are locked up in there. And if this entity doesn't pay back their loan, then they get their stuff wiped out that they had collateralized on there, and you make back the funds that you loaned out. And there's no lawyer you need to go to. There's nothing you need to sign. It's all right there, and it just executes. And I remember covering that aspect as a risk mitigation to some of the crypto world.
Yeah. And I mean, and it's not, I mean, while centralized exchanges are not for me, are not, for us, and they have these exact risks, I do think there is a future where they stick around for quite a while, especially in the case of the TD Ameritrades and the Fidelities. And when they start coming online, idealistically, I kind of foresee them taking over and a lot of these other players fading down to lower tier. But that's besides the point. In the meantime, so anybody that is like, well, I still want to expose myself to this risk, but I want to trade on a platform. The one thing I've seen developing in the last few days is the centralized exchanges that are still out there. There is a groundswell of movement. I am not saying it's all trustworthy. I am not putting any backing into any of it. I'm saying
we are not financial professionals.
We are not financial professionals. But I'm just saying these are the conversations you want to tune into, and the things they're talking about are basically how can they present themselves, not with words, how can they prove that they have what they say they have. So Coinbase is very active in these conversations. There's other platforms. I honestly I won't use their names because again I don't want to sound like backing any of these per se or giving that that Tom Brady seal of approval. But the things they're talking about are very important. They're talking about, a lot of them are saying, yes, we have one-to-one asset backing. If there's a bank run on our platform, if everybody runs on it, that sucks for us. But, we don't, we have profitable businesses elsewhere or other lines that we get our revenue from. And it's not going to it's not going to cause bankruptcy or insolvency or anything like that. If there's a bank run, we have one-to-one assets to give everybody their assets back. That's all well and good to say, but it's important that the part of the conversation that's missing but is developing, which is the part that I'm tuning into just to be aware, is how they're planning to prove that. And there could be an episode on that, on the how. It's also still developing, so I don't want to get too into it, but there are some very clever ways to prove they have what they say they have, and they have your funds and things like that. But still high risk. But if you want that exposure, these are things that need to be part of your due diligence before entering and getting into it. So that's basically, kind of a little bit of my views, as well as just trying to decipher the flood of information that is hitting basically, as far as I've seen, all channels, all news outlets. I definitely wanted to at least acknowledge the situation because of, we talk about this stuff. And so I do not want anybody, like I said, to touch crypto and not have done a lot of due diligence. Pop into the Discord, ask us questions. I will be happy to point to different places that I've learned a whole lot of stuff while getting into it. And certainly, just because this all exploded, I remain very, very steadfast in my opinion that is this the end of crypto? Absolutely not. To me, this is I've coined this the great shakeout. This is just the rug has been picked up, and it is just, it is so dirty, just shaking out all these bad actors. There has been zero, as per the example with the decentralized finance loans, there has been zero in all of every craziness that's happened this year, in the movie you watch in the future that certainly will be made. There's been zero that invalidates the core functioning tenets of a blockchain technology, of which some of these cryptocurrencies are built on top of. And it's that focus that has me convinced this isn't the end, but this is a very, very necessary shakeout of just a lot of bad actors. And thus, there is more pain to come because those bad actors have all kinds of domino effects that ripple through the system. It is certainly still not a good time to jump in per se, because there is just so much unknown about what happens next. But it is this moment where the future of it depends on how regulators respond now. This certainly was big enough that they were dipping their toes in the water before. They can't avoid it anymore. And this is also the perfect moment for them to come sweeping in when the room's been cleared, when all of these buildings have fallen, to lay this foundation. And I do suspect that they will, because, obviously, even from the White House, it's been said, like, we're not of the mindset to ban crypto, but also to be a leader in this digital economy. So I expect that to happen over a much longer period of time. And in the meantime, there's certainly a lot more ripple effects that you should probably watch out for, even if you're not in crypto directly.
Yeah, touching on that next step to bring regulation in here, I kind of agree that it is probably coming. We did an episode, I think it was when Celsius was collapsing, Voyager was kind of collapsing as well, and we pulled up a retirement pension fund up in Canada or something like that that had exposure to some of that and lost tons of money, where very real everyday people were getting swept up in this. And when it comes to regulation, I think that's really when people start getting involved. And I'm personally kind of hopeful that the, you know, larger players in the equity space will kind of come in to help maybe push for some of that regulation. In a lot of industries, when regulation arrives, the leaders of that industry or the participants of that industry actually propose the initial regulation. So, you know, I worked in the automotive space for a long time, and whenever there was new technology coming out or new prospective regulations on the horizon, you know, those automotive companies, whether it's suppliers, OEMs, they would start to kind of petition and work with people in Washington to try to nudge regulation in a particular direction, because they're the ones that had the subject matter expertise. You know, some people could say, well, they're just doing that so they can get good or better regulation. I'm like, well, if you think about it, people in Washington making regulation are a little bit disconnected from the actual situation and what's feasible, what's not feasible, things like that. So, you know, I think that is probably one of the greatest possibilities or kind of hopes for pushing some of that, is that you'll get some of the players that are, you know, running exchanges, been through the regulation of the traditional finance to help lead some of that. But I also say it's really needed because, you know, we're really touching on everyday people. This is not some niche thing that a few rando people in their basements are participating in. The estimations right now of FTX's bankruptcy are going to be the largest bankruptcy filing in the history of bankruptcy filings, with well over 1 million creditors out there in it. And so we're talking about just everyday people. We're talking about, you know, big investors, little investors, and it's really reaching everywhere. And, you know, it's the long lasting implications of this to me is, yes, there's a direct impact to all of those people, but more than anything, the bigger impact is going to be the blemish that the technology gets from this. You know, whether or not it was the cause, the technology itself was not the cause of the problem, right? It's the people wielding the technology, the people doing that was the cause. But that distinction doesn't really get made. And so I think there's going to be a lot of sour opinions for a while on crypto in general, because they just know, oh, crypto, that's that FTX thing. What a terrible situation. That's like a modern day Bernie Madoff Ponzi scheme or something to that effect, right? It's that stereotype, that opinion that gets kind of swept up and ran with. And one of the things that I recently read, Tom Sosnoff is I'm a fan of his. He's basically created lots of different option trading strategies. He's created option trading platforms, and he put out a commentary maybe about a week ago, and he was commenting on SBF had tweeted or commented or sent an email that he effed up. He's like, oh, I'm sorry, I really effed up, you know, this, that, and the other thing. And Tom's response to that was, dude, like, you F up if you order a pizza and forget to put pepperoni on it. Like, you lost $8 billion, evaporated. There are millions of people that lost huge chunks of funds. That's not an F up. Like, it's just kind of just frames it like this is massive. And it's sad for a lot of those people that took a leap into trying something new and got burned a little bit. Because that will leave scars. You know, I was one of those people that we talked about my first back into crypto space, where I had transferred 29 Bitcoin, I believe it was. I can't remember the exact. We go back and look. To an exchange at that time. The exchange was called Mt. Gox because I wanted to cash out. That was how you cashed out. I transferred my Bitcoin in there. Within 2 weeks of it being there, that exchange completely folded up, disappeared, went off the face of the planet. And so, you know, part of my aversion to some of this stems from, yeah, I touched the stove once. It hurt. And, you know, that was when things were really niche. now back then it was maybe, thousands of people involved in it. This time around, we're talking millions of people had their hand on that stove. So it's unfortunate, and hopefully that some positive can come out of here where regulation can emerge and we can have a safer trading space, because like Viper said, there's a lot of value and benefit to the technology, but with anything, it's all in how you use it.
Yep. And the last thing I did want to say is, if you're of the mindset of, you're the advocate, you're the kind of person that likes to see important change in Washington, there are a couple bills that are already in circulation. There's one that's more talked about that I still need to read, so I'm not going to mention it because I haven't read it yet. But there is one that I do have my eyes on, and I'm going to mention it in case you're that kind of nerd that would want to read a Senate bill. But I think it's important to, especially if you're of the mindset of like, I want to get into this, but I want to wait for more regulation, or if you're just personally concerned, which is a very natural concern of just your own implications to get into a digital asset. This bill is very complete, and I've skimmed through it, and I'm actually now about a quarter of the way detailed reading through it, but it's Senate Bill 4356, and it's referred to as the Loomis-Gillibrand Responsible Financial Innovation Act. And so I do recommend just going and looking it up, skimming through it, because I think it is one of the most complete approaches to reasonable regulation of the space and definition of which one of these things are securities, which one of these things are commodities, and all that kind of stuff. And it's a very good framework, I think, for the space in general. However, like we said, for exchanges and things like that, that's just something that we need to listen to the exchanges themselves as to what they think the regulation needs to be, and then also, balance that with what ends up happening.
That brings us to the end of this week's episode. Hope you enjoyed kind of the look back here on the FTX situation. We didn't really dig into a lot of the details around it because a lot of them are just unknown and there's a lot of speculation out there. However, you at least got our opinions on the context of it and kind of the things moving forward and some of the implications as we see them in both the immediate term and future longer term. So, things are pretty crazy out there in the market, as always. A lot of volatility, a lot of turbulence, both in the crypto space and in the equity space. Lots of more data points coming out. So good luck out there in all that you do in trade. And remember, think outside the block.